Good morning, everyone. You're all very welcome to the last webinar in our series on the building blocks for scale. Today, we're going to be discussing how to obtain the funding you need to scale your business. So my name is Tom Early, and I lead the Funding and Scaling Solutions team within Enterprise Ireland, the goal of which is to work with our clients to help them access appropriate funding to scale their business in a rapid and sustainable way. Now, one of our key strategic objectives for Enterprise Ireland is to develop more Irish companies of scale, so to encourage more founders to continue their scaling journey. During 2020 and 2021, there was a high volume of acquisitions of our rapidly growing companies. In my view, the founders were selling too early. So I wanted to understand why and identify what is an actual barrier for our clients in scaling their business and how I could encourage the companies to remain Irish for longer. So what we did is we undertook a review of 101 separate transactions that had happened over a 2.5 year period, where the founders had decided to exit rather than continue the scaling journey. We spoke with the companies, with corporate financiers, with the development advisors, the investment advisors, basically anybody that was involved with the company or the transaction. And whilst the common narrative that came back was access to finance was the problem, and I might ask you to put up the next slide, the overall conclusion was that it was a lot more complex than just simply lack of funding. The inability to access finance in general is more a symptom rather than the root cause of a company deciding not to continue its growth journey. And look, we identified 9 common themes, and they're not ranked in any particular order. One of them was cost, both financial and non-financial. The founders didn't want to give up equity, or they viewed that the cost of the money was too high, or that they didn't want to give up board seat. There was founder fatigue and risk appetite. Let's be clear, there's a lot of work that goes into making an overnight success. And when you're offered a sizable check, it can be hard to say no. Early investors want out, and this can pressure the company to raise finance or pressure the founders into accepting a deal. Now, that's not necessarily always a bad thing. And speaking with one of the companies, they were put pressure on by their early investors who wanted to get out, which forced them to go and seek PE funding. And something that he wished he'd done years before, because when he took this funding on, it really accelerated the growth and the international expansion. There can be conflict at the board or between shareholders, and this can paralyze a company. And unfortunately, I've seen that happen far too many times. One of the big things that came out, though, is a very, very strong theme, and it's something that I see time and time again, is the lack of sophistication and realism in planning and managing the fundraising journey. Not communicating with investors early enough. Seeking investment when you can't pay the wages next week isn't ideal when you're looking for a long-term strategic partner. Or you concentrate on talking about the products, but not the investment opportunity. So at today's session, and I might ask you to put on the next slide, we're going to hear from Matt O'Dowd on how to engage with your investors in a meaningful way, how to articulate your business in terms an investor will understand, and how to select the right one. And then we're going to hear from Conor McCarthy, the CEO and co-founder of Flipdish, one of Ireland's unicorns. And for those of you who don't know what that is, that's achieving over a 1 billion valuation. And he's going to take us through his funding journey at the various different stages. And then at the end, there's going to be an opportunity for you to have asked your questions. So I would encourage you to put them into the Q&A as you're going along. And we're going to be joined by Owen O'Kane, who will help consolidate all those questions later on. So look, without further ado, I would like to invite Matt O'Dowd, who's director in Numis, to come and onto screen. Now, Matt's been working for over 10 years with Numis, and he's focused on raising capital for private companies. And he was part of the Flipdish round and many others. He's also a member of Endeavour Ireland and sits on the board there. And he works with a lot of high impact entrepreneurs to ensure they can fulfill their potential. So Matt, you're very welcome.
Great, thanks, Tom. Thank you for your kind words. So yeah, look, I'll just start on this slide and just kind of give an overview of Numis and where we play. So Numis is a global investment bank. It's got offices in Dublin, New York, and London. And really, we're kind of seeing deal flow across all aspects. So from really early stage companies in our growth capital team, working with founders at the Series A stage and onwards, right the way through to taking US companies public like Nubank at a $50 billion valuation that are listed on NASDAQ. We're also seeing a huge resurgence in M&A. It's been very busy for us over the last couple of years, and seeing lots of kind of complex structures that are happening as part of kind of carve outs or private companies, to Tom's point, that are probably being taken private or being acquired a little bit too early in their journey. So we're kind of seeing it from a global aspect, but also across all the different structures. So if we move to the next slide, I'll just talk about our kind of private capital markets team, which is what we call growth capital. That's where I sit. I co-lead the team with another guy. And since January 2021, we've raised about $6 billion of capital for private companies. Some of those are the likes of Flipdish, around the kind of $1 billion valuation. Others are as big as Nubank or Klarna, that are touching on kind of $50 billion valuations and raising hundreds of millions in a funding round. Our average round size, dating back to 2021, has been about $250 million. And we're working with founders, right across the globe. So it's not just Ireland, but we're working with founders in Israel, in India, in the US, in Latin America. So we're kind of seeing how all the different deals are being structured in different markets, which is just quite interesting for us. Next slide. So I thought I would kind of touch on the different kind of types of funding that are available in the private capital markets, and these are probably the types of funding that we're seeing that are most common. And one thing I would say just to start is, you should really, as soon as you're thinking about funding for your business, you should look at all the different types and try to think about what type of funding is right for your business at that time, because they're all quite different and they all have different implications. So if I start with equity capital, this is raising new equity financing for your business. This is increasing the number of shares you have in issuance, diluting the ownership of the company, but bringing new investors into your cap table. And this is typically, we see both preference shares and kind of common shares being issued here. And I can go into more detail on these complexities in the Q&A. The second kind of type of financing we're seeing, and probably a financing that has been most common in the last 6 months, given the kind of downturn in private capital markets. Structured equity capital has definitely taken up, and what that is raising new equity, but with structures in place. And really, what these structures are trying to do is they're trying to provide some downside protection for new investors that are coming in to the cap table, and that can be in the form of a liquidation preference, ratchets, warrants, complex structures where the investor is really trying to give themselves, downside protection. Because obviously investing capital comes at a risk. And so at this point of the market, we've definitely seen, a big shift from 2021, when private capital markets were, very, very active. It was much more of the kind of vanilla equity capital raises we were seeing. This year, it's definitely been more of the kind of structured equity capital raises, which has been interesting and been complex, and it's definitely taken founders a bit more time to get used to these structures. And then the final piece is debt capital, and that comes in various different forms depending on how early stage your business is or how late stage it is. And it could be through venture debt, senior notes, convertible loans, revolving credit facilities with banks, and that really will depend on kind of the stage of your company. But all are very viable options. But again, before any fundraising or any financing, the earlier that you start to think about these structures and understand the structures and the implications that they'll have, the better for you as a founder and as a CEO of a company. If we go to the next slide, so this is super important, and something me and Tom talk about quite a bit is how do founders and CEOs articulate their story in a really meaningful way for a funding round. So it's important to think about, if I start with who are the different types of investors that you may go to that are out there, and there's various different types of investors, from crossover investors to growth equity and venture capital type investors to sovereign wealth funds to family offices, and they're all relevant to you in a funding round, but some are more relevant at different stages. And so, what we have seen consistently as my team has acted on, multiple funding rounds, these kind of pillars of the equity story coming onto the product and mirroring that with the use of proceeds is very, very important. So, touching on the equity story, and these are all probably questions that you've asked yourself as a founder or CEO, but it's very important that you touch on them. Is what is the problem that you're trying to solve with your product or your business? How big is the market that you're selling into? Who is the team around you as the founder? What experience do you have? Have you done this before? Have you not? They are critical questions investors will want to see in your kind of investor deck up front. Then there's diving into, what is the product that you're selling? How is it priced? What is your moat? Why is your product better than other products out there? What does the competitive landscape look like? What is your go-to-market strategy? So are you just selling your product in Ireland? How many salespeople do you have? Are you thinking about expansion into the UK? Are you thinking about expansion into the US? And are you going to use partnerships to help you accelerate into those countries? Are you not? And then, bringing that together, what does this mean then for your financial forecasts? So, hopefully you'll take away some of these slides today, and they might help you as you think about your investor presentation. But having gone through multiple funding rounds, they are the questions that we see time and time again from investors, and that we would always try and ensure that you've answered before you kind of go out to market. And then it comes on to the use of proceeds. So what we always say is the kind of more reassurance that you can give to a new investor around your strategy, the better, and particularly around the financial forecast that you're putting forward. And what I mean by reassurance is if you say you're going to do 50 million or 100 million of sales next year, what sales have you done the year before? Are these sales contracted? Are they not? Does it all predicate on you launching a new product or going into a new market? The more reassurance that you can give to an investor who's going to provide you with capital, the better. And what we've seen this year is investors going into their investment committees. So typically global investors will have investment committees where they approve an investment or not. And the ones that we have seen be more successful than not this year are the companies that are definitely able to provide more reassurance about the numbers that they're putting in front of an investor. So having your strategy aligned and going into the funding round, you then need to think about what are the use of proceeds, where are you spending the capital, does that capital mirror the strategy that you've outlined in terms of the markets that you're going to go into, the products that you're going to launch, the costs that you're going to put into the business for next year and the year after. The use of proceeds needs to be very, very well thought out. Because investors don't want to give you money for the sake of giving you money. They want to see it being used very efficiently to grow your business. And so I'll just touch on some of the different types of investor as well, so that you have that. Is if you take a growth equity type investor, which is a kind of venture capital firm or a growth equity investor, they will want typically to have a board seat and be able to dictate the strategy of where the company's going to some respect. And so understanding the venture capital landscape and the growth equity landscape and understanding who you're speaking to is very, very important. I'll then just touch on, crossover investors who have, you've probably heard a lot of the names over the last few years. They've been investing an awful lot, but they would typically invest in both public and private companies. I think a lot of them got very heavily involved in private markets over the last 2 years, but have somewhat retrenched. And the venture capital and growth equity type investors have stayed there consistently over time. And then the other two pools of investors, and we can touch on this later in the Q&A, and I'm happy to have conversations offline, are the sovereign wealth funds and the family offices, who typically wouldn't take a board seat and typically will provide you with capital and they can help open doors within their network, but it's a much more kind of hands-off approach. So one thing I would definitely say is, before the funding round, understand the type of capital that you think you may be looking for. Understand, how much you think you need to raise, and does your equity story align with the use of proceeds? And then finally, I think spending time with investors is super important. Understanding the different types of investors that I've talked about, from the crossovers to the growth equities, the sovereign wealth and family offices, they all offer very different things. So understanding, what type of bucket does the investor sit into? What can they add to my business? Understand other companies that they've invested in their portfolio. Typically, it'll all be on their website, but if you're using an advisor, they can also help you too. Have they invested in similar companies? How have they been helpful to that company over time? And one thing that myself and Tom talk about consistently is, some founders try to say that they'll only speak to investors when it comes to a funding round. I personally don't think that's the best strategy. I think you should, I completely understand that founders need to run a business day to day, but I do think that they should try and put away some time to speak to some investors over a period of time. And so you really need to get to know, the investor that you may take capital from. If this investor is to come onto your board and be a very important part of your strategy and the future of your business, you really want to spend time with them and get to know them and make sure that they're, really nice people and that they can really help. So I think one thing I would definitely advise is spend time with investors, understand who they are, what they can add, what they're like as people, because they're the most important partners for you into the future. So yeah, next slide. What I've done here, and you can take it away, is these are just different funding rounds that we've been involved on over the last couple of years. They're very different in nature. Some of them, like Wiz, which is a $300 million round, is all equity. Something like a Casavo, there was a fairly big debt component with that transaction too. Something like a Nord, there was a bit of structure and a bit of equity. So, the reason why I kind of have them here is, Google them, have a read about them. You'll see the different structures and how they were kind of put together. But they're just good examples of different types of transactions that have happened over the last couple of years that you can read about and learn from. This was all debt, this was equity, and you can see how the founders kind of talked about the funding round and how it came together. And I've just outlined just some of the investors that are on the cap tables of these companies. Very global type investors. They all add very different things. Some are crossovers, some are growth equity. So just always important to kind of read about other transactions that have happened, kind of what's going on in the landscape. So I've really just highlighted a few here and on the next slide too. So please feel free to have a Google of them, read about them, see how they were put together. If you have any questions, please follow up anytime. I'm happy to answer any questions in the Q&A after this. Back to you, Tom.
Matt, brilliant. Matt, I might just ask you one quick question while it still occurs to me. What is a moat? I saw it there on your slides. Is this what Warren Buffett refers to? Is it? Or,
it is.
Yeah.
It is. So, having a compelling moat, essentially, how difficult is it for another company to do what you do?
So like your USP.
What is your USP?
Yeah.
Exactly? And how defensible is it? If I gave you, Tom, 10 million euro tomorrow, can you create that tomorrow? Is it very easy for you to do? Is it not? So that's how we think about moats.
Okay, very good. Well, the answer is no. I definitely wouldn't be able to. But all right, that's brilliant. Look, I might invite Conor McCarthy on now. So Conor is the CEO and co-founder of Flipdish, and he set it up in 2015, and he now has achieved a unicorn status. And I understand, Conor, this isn't your first go at the rodeo. That you are actually a serial entrepreneur, and you've done this one or two times before already. So. Look, I might just ask you to start off maybe and talk a little bit about Flipdish.
Yep, thanks, Tom. Really nice to be here. Thanks for the invitation. So yeah, I'll give you a quick history on Flipdish, just so we have a bit of context about why we have been raising funds. So we started the company back in 2015, myself and my brother James, and the problem we were trying to solve was really just a personal one. We were both really frustrated trying to order our takeaways online. It seemed back in 2015 that nearly every other industry had digitalized really well. Back in 2015, you didn't phone an airline if you wanted to book a flight. If you wanted to book a hotel, you just went to a website and booked it. The Halo app was out in Dublin at the time. You could just open an app, tap a button, and a taxi would magically arrive. But it seemed that if you wanted to order takeaway, it was much easier to phone the restaurant. There were some marketplaces becoming very popular in Ireland and the UK, but the ordering experience, especially on mobile, was not amazing. And yeah, I found myself phoning the restaurant more often than not, and it seemed like nobody was really trying to solve this problem. So we set about trying to solve it for ourselves. We designed an app that was just massively easier to use than what was out there at the moment. And our plan was to have a single app, the Flipdish app, which listed all of the restaurants in the country. People would open it and place an order. So we set about building that, and we ended up with an app which people could open for the first time, register and place an order in less than 20 seconds, whereas it was taking more than 2 minutes with the marketplace apps and big apps like the Domino's app. And the reason it took so long with those apps is they asked for so much unnecessary information. On the marketplaces, you need to enter your email address twice to create an account. You have to enter your password twice. If you forgot your password, you have to enter your email address again, go check your email, come back. It just took a long time. And the Domino's app asked for your date of birth before you could order a pizza. I just couldn't imagine being asked that if I walked into a Domino's. So we ended up with this wonderful new app we plan to launch as a marketplace. And we listed all the restaurants in Dublin, and they weren't aware of this at the time. We just received the orders online, and then when an order came in, we phoned the restaurants and placed it on the customer's behalf. But we were very motivated then to sign up restaurants properly, so every evening wasn't taken over by phoning restaurants manually. And when we started talking to restaurants, they immediately told us they really did not want another marketplace. They explained to us that they wanted to maintain control of their customers, have a direct relationship with them, because they told us that they used to have customers that would phone them every Friday. You'll walk into their takeaway every Friday or Saturday and place an order, and now they're going through marketplaces and they're being charged 10, 11, 12% for every order, and these rates kept going up. And we, neither myself or James, really want to start a business where our customers didn't like us. So we decided to pivot entirely and offer them what they wanted, which was their own branded mobile apps, their own branded websites, their own loyalty systems. And since we did that, things have been going pretty well. We now serve about 7,000 restaurants in about 20 countries, and more recently have started helping restaurants with their back of house operations. Whereas for the last 7 years or so, we've been helping them with their customer ordering experience. We're now helping them with all of their back of house operations with their restaurant management system. So will I chat a bit about the funding history?
Well, that's something I really want to find out about. I mean, unicorn status is rarely given to companies. So you might just start on your funding journey. How did it come about? What, like, did you friends, family and fools, business angels? Where did it come?
Yeah, I think we definitely, despite the recent fundraisers we've had, definitely were not good at raising funds at the beginning. It felt like for about 2 years we were talking to every VC in Ireland and a couple internationally and just couldn't get anywhere. So we relied on friends and family initially. We begged for €50,000 to get started. That allowed us to build the iOS app. And after we had built that, I remember it being a really big decision whether we would continue and beg for more money to get us to build the Android app and like web ordering system and a web hosting platform. But we did. We decided we were seeing enough traction with the iOS app that we would make that ask. And we relied on friends and family funding for about 1.5 years. And it's not because we weren't trying to raise money. We were talking to anyone we could to raise money, but we weren't really getting anywhere until we met a guy called Gianni from Growing Capital, who is an angel investor. And we came across him because after we'd spoken to a couple of VCs, we learned that VCs don't always have capital to deploy. So we'd spent some time talking to Irish VCs and then realized after they passed on us and we were told, but they don't actually have funds at the moment. So we realized actually we're wasting our time talking to them at this point. So we changed tact and started looking for Irish companies that had received funding and then tried to work out where they got the funding. And we discovered a company called Glowfox in Ireland and saw that they had raised funding, and we asked them who invested in you, and then we were put in touch with the investor, and he took a punt on Flipdish, and that was our first kind of outside money. And Enterprise Ireland matched the funding there. So we'd raised 500,000, which was amazing. That allowed us to actually hire some people and go to market with Flipdish. And we realized we quite enjoyed spending the money. So we kept looking and kept talking to VCs. And again, we didn't seem to be getting anywhere until we came across Elkstone, which wasn't back. Elkstone now have a fund where they invest like a more traditional VC. That wasn't how they operated back then. They had, the way they operated was they identified companies that they thought were interesting. And then once they'd identified a company, they then went to their group of high net worth individuals and asked them if they were interested in pooling together and investing. And that worked really well for us, but it was a very long process because they didn't have the funds ready to go. It meant that first we had to get Elkstone kind of on board with the idea of investing in us, and then wait to see if they can get the funds in. So that took about 6 months, I think, from when we agreed, yes, we did want to do a round till it's closing it. And we finally got that round closed in the nick of time because we were spending our money that we'd raised before, and it was taking longer than we expected. But we got there just about in time. And then about 2 months later, we got an email from Global Founders Capital, and what had happened was James, my brother, had been talking to various VCs over the last year, and GFC was one of them, and they passed back then. And I think the person they spoke to had moved on and left the company, and then a new person working in GFC was going through the old deals, and he came across Flipdish. So they emailed us on a Wednesday morning, and I was on the phone to them then on Wednesday afternoon and updated them as to where we're at. On Friday, I was in Berlin chatting to Ollie, the lead there in GFC, and we had a term sheet all done on Monday. And I realized it isn't a stereotype that the Germans are efficient, and I really appreciate it that it went so quickly. So that went very well, very quickly to get to the term sheet stage. But what was different with them was, as a more institutional investor, they expected a lot more due diligence, us to have our books in order. So we had a lot of work trying to work out how to do that for the first time.
Okay. So pulling together a data room, giving them all the information they were asking.
So they would have asked for things like a dump of all of our orders, so they could see the like the churn rates of our customers, churn rate of the end users, and get a full picture. And it was actually really useful because we sent them the raw data, and they sent us back great analysis on our company, which helped us understand ourselves a bit more, which was nice.
Yeah. Good. And so then how did that was the next round? Because that's what, about 3 rounds in, or is that 4 rounds in now at this stage?
So we had friends and family, Enterprise Ireland and Grown Capital, which we called a seed round. We called the Elkstone round a Series A, but then the Global Founders Capital round followed shortly after. So I think we probably rebranded the Elkstone round as a seed round or something. So yeah, that was our 1, 2, 3, 4th round.
Yeah.
And that was loads. That was about 7 million we'd raised. So that kept us. I mean, for us, that was a huge amount of money at the time, given the size of the company. And then we were like ticking along pretty well with that funding. And in 2020, a couple of things happened. Like Flipdish continued to grow. Also, the market seemed to be starting to get quite hot. It was a very, I suppose, strange year for Flipdish. COVID hit in March, and 30% of our restaurants closed their doors overnight, and our revenue plummeted. So we were very concerned at that point about the future, because we didn't know if restaurants. No one really knew what COVID was at the time. We didn't know if restaurants would be opening up at all. But then about 2 months later, lots of restaurants reopened, and lots of restaurants who didn't do delivery before were starting to deliver, and that really helped Flipdish grow. So we were talking to investors about raising then. It was very difficult for them to know, would this new revenue stick? Because we'd seen like a big uptick in revenue as more restaurants wanted to deliver, but nobody knew if that would stick after COVID ended. No one knew when COVID would end. So even though Flipdish was doing really well at the point, it was very difficult for investors to understand if we actually were, if it was just like a short bump in revenue, or if it would stick. So we weren't really able to close or like find an investor who would buy into what we were doing for quite a long time, until December, really. And at that point, and I think it took until December because people realized they could see they had a bit of history then. There was 6, 7, 8 months of seeing how consumers were behaving during COVID. And we ended up with 5 term sheets in that round. It had taken us, I think we'd probably been negotiating with 3 investors who gave us term sheets for about 2 months. And I very much got the feeling that they were focusing on the wrong things. They were like, it was just taking a long time for them to move forward. And this is when Tiger came in. It's a little similar to GFC. I had a 30-minute phone call with one of the leads in Tiger, and he said, I'll get back to you in 2 weeks. 2 weeks later, we had one more phone call for about 45 minutes where we agreed the headline terms of the term sheet, did a virtual handshake over Zoom, and that was it done. And it was just so much faster and easier than a lot of the other potential investors that we were talking to.
Was there something you'd learned from your previous engagements that you then, when you were engaging with Tiger? Yeah, was there something you'd learned from those that you brought through that you suddenly cut through a lot of the time?
I think it was probably more them than us. So we did have our data room ready to go, which made it much easier for them to do their due diligence.
That's very important,
yeah. So they could just tear through that in over the 2 weeks. I think what they do differently, or did differently at the time, was they were known for not really asking the companies they invest in for information, but instead doing all their DD in the background. So going to our customers, phoning them, asking them about us, how they feel about the business, talking to our staff and getting the inside story there, as opposed to just asking the founders. Because I mean, if you ask a founder, they're probably going to tell you what you want to hear. So it seems much easier from our point of view because we didn't actually have to do anything. They did the work in the background. But it definitely made a difference, the fact that they moved quickly and made it easy for us to agree.
Okay. And I suppose then, if you look at how you engaged with Tiger versus how you engaged at the very beginning, like how did you educate yourself on the various different funding strategies? I mean, did you go out and grab in a corporate financier at this stage, or like what was your thought processes with deciding about getting help?
Well, in terms of educating ourselves, when we were just starting off back in 2015, read a couple of books on VC. I read one called Venture Deals, Being Smarter Than Your Lawyer and Venture Capitalist, just really to get, it was all new to me. I didn't know the terms, didn't know what convertible debt was, didn't know what preference shares were. And it's all in the book, so you can just read that and learn all about it. So I read just a couple of books to get the nomenclature down. And then later on, we had spoken to a couple of investment banks, and it never seemed to make sense for us. I think primarily because of the way they structured their deals, and that they wanted a large retainer that would be paid even if no deal came through, and it didn't seem like our incentives would be aligned at all. But we got an email one day, cold email from Matt, who introduced Numis to us. And what was different there was they were willing to just look at our data room effectively, and they came back to us with what they thought the company should be valued at, and how they thought they would be able to successfully raise a round for us. And they were happy to align the incentives so that if we successfully raised a round, they get paid for that. And that worked really well. I think we were definitely very well aligned, which was great. And they were able to truly, and they took time to truly understand our business and knew which type of investors we should go to.
Yeah, well, that's a nice segue into me inviting Matt to come in, and we can open up the question to the floor. So again, if anybody has any questions, I would ask is to put them into the Q&A, and Owen is going to review them and consolidate them and come back to us. But Matt, maybe just picking up that point there. So yeah, I suppose you engaged with Conor. You might just take us through your thinking on that, how you'd come across Flipdish. What was it?
Yeah, so I mean, we're always screening different sectors for new technologies, innovative companies. and trying to find them as early as we possibly can. My team today is a team of 10, and then we also leverage sector teams. So we have various different sector teams, from TMT to building and construction to consumer to media to financial services. So a kind of combined effort between our privates team and our various different sector teams allows us to identify companies across all stages. And Flipdish was one that came out of a screen they had just raised. It felt to us that other companies in the market were growing incredibly quickly. And I had heard very good things about Conor and James from my Irish network, that they had created this amazing business. They were very good founders, and so that led me to Conor and James. I remember when we did an initial call and we got some of the data, we were just blown away by the customers that Flipdish had signed up, just how much they were using the Flipdish software platform. It was quite incredible. And that's what got us, really, really excited about the team meeting Conor and James, but also, as Conor said, when you dig into the data around the company, the customers that they have, how good the cohorts are, and how many countries it is in, it's quite an incredible company. So that definitely piqued our interest and got us, very attracted to Flipdish.
And maybe you might ask this, like I probably have a lot of startups and stuff that are online here today. At what point should a company consider involving a corporate financier?
Yeah, Conor should definitely answer this too from experience. I think in the early rounds, I think seed and Series A, I think it's probably best for the company to do those rounds themselves. As Conor said, a lot of it can be kind of friends and family money and network. So I think in the earlier rounds, seed and Series A definitely makes sense for founders to do it themselves. And then from Series B onwards, I think that's when the types of investors somewhat change. I think seed and Series A investors are very different to the kind of more classic growth equity type investors and crossovers and sovereign wealth funds that get involved from Series B stage onwards. And that's when the funding rounds get slightly bigger, they get slightly more complex. And I think then it can make sense for a company to engage an advisor. And I think once you've kind of set out that you're going to do a Series B, even kind of a year out or more, you should just be chatting to advisors and getting to know them as much as you can. I think Conor can definitely comment, we always align ourselves with the founder and with success. We're only ever paid if it is a successful outcome, and that's the way we feel it should be aligned. And that way it keeps us both honest and we're both fighting for the same outcome, and that's what we want. I think it is a people game. You want to enjoy the people that you work with during these funding rounds. There's going to be tough times and tricky times, and there's going to be some really good times. And so I think you really want to trust those people that you let into the camp and that become part of the team. So spending as much time with them before a funding round is super important, both the advisor and the investor.
Yeah. So Conor, any comments on that?
Yep. Yeah, I totally agree with that. I didn't have experience using a financier in the earlier rounds, so I can't really comment on whether it would make sense. But they do seem to be much less common in earlier rounds, so I suspect that it doesn't make sense to do. Although, I don't think probably the level of funding demands that the financiers would be able to make doing it doesn't make sense to them. So probably the service isn't there. And I think it would also come down to the actual founders and where they have shortcomings and where they need help. I think for us, like a definite shortcoming we had was pitching the company in the correct way, and Numis and Matt brought a huge amount of value there. I think like financiers will tell you they can get you in contact with the VCs, but I don't think there's any VC that we couldn't have got in contact with at the time. But what they were able to help with was getting us in contact with the decision maker straight away, so that we weren't spending time going through the different layers of the VC, and also being able to manage getting all the decision makers lined up quickly for us, so that we could just go day to day going from pitch to pitch to pitch. Because we didn't have the time to do that ourselves, and because we didn't have time, we just wouldn't have done it, and we wouldn't have got to speak to so many decision makers over such a short period of time, which definitely influenced the outcome.
Very good.
Yeah, I think that's a really important point that Conor makes is, having the engagement with the decision maker at these venture capital firms or these investors is super important. Having it come from the top down, as opposed to the bottom up, definitely increases the chance of conversion. We see a lot of time, and I remember me and Conor are always kind of sharing emails on who's emailing him and who's not, and that kind of stuff. And the last thing we would want Conor to do is spend hours and hours with quite a junior person who can't make a decision at a firm, and he's just wasted 4 or 5 hours and some of his team's time. We want to try and avoid that at all costs, because Conor has a business to run every day, so we want to make sure it's as efficient as possible.
Matt, that's probably a good segue into a question that's come through on the chat, and I might just pose the question to both of you, and I might start with Conor. And there's interest on getting 5 term sheets in at once, and how the process you went through to do that and creating that competitive tension. So there's some interest on that. And then Matt, I might just pose the same question to you about how you run a process and create competition to drive a better outcome.
Sure.
Yeah. So I think it is very important to build that competitive tension. I think if there's like a really brash person selling their house, they'll organize for everyone who's looking to buy it to come in at once, so they see that other people are interested, and it just changes the dynamic. So really, that's just happened naturally for us, because we decided, okay, we're going to go full into fundraising mode. So we started reaching out to all the VCs that we thought were suitable for us, and doing that at the same time meant that they're all kind of at the same level, at the same stage in the process at the same time. So the term sheets started coming in, and I'm certain the fact that we had other term sheets influenced Tiger's decision to invest. They're like, okay, if 4 other investors, decent investors, are offering term sheets, we have some confidence that it makes sense they've done some of the work for us.
Okay. Yeah,
and Matt,
I completely agree with Conor. That's exactly it. I think what we try to do is we try to set timelines, very firm kind of timelines around when we expect to get term sheets from investors. And so it keeps them to a timeline, keeps them honest. You can keep them checking in, and we make sure that everything from the data room to time with Conor and James is available within that timeline. The most important thing with the funding rounds is momentum. And to Conor's point, when other investors think there's momentum, they're more likely to step forward. They're more likely to come forward with a term sheet. And then, as Conor said, when you have more term sheets, I think that really can accelerate the process and create momentum, because multiple people have done their work, they've been comfortable, and then you can start to have negotiations between the different VCs who've come forward with term sheets. So it's definitely momentum, super important, and being very strict with timelines and letting the investors know that there's a timeline that they need to work to is very important, or else the funding round can drag on for months and months and months, which is not what we want to do.
So what would you say? Yeah, what would you say to an investor who's turning around and going, look, I don't want to be involved in a competitive process. Just chat with us for the first while. Like how? Because I hear that a lot from companies. They're only engaging with one VC or investor at a particular moment in time.
Well, I'd advise against this. They may not want to be in a competitive process, but it's tough.
Yeah, very good.
If they fall out because somebody else is offering a better deal, then you have a better deal anyway.
Yeah.
I think not only is having everything aligned at the same time help build up the competitive tension, but it's really useful to negotiate, because you can read all the negotiation books in the world, use all your energy and negotiation skills to get a better deal. But if you can just say somebody else is offering me this, it's better. That's so much easier than anything else.
Okay, very good. Owen, is there any other questions?
Yeah, there is. There's a couple of questions. There's a bit of a theme, and it's actually at the earlier stage. So the seed funding. So I might throw the question to Conor. You obviously referenced the importance of your network in raising your seed funding, and, for example, speaking to Glowfox and then connecting through that. So any insights or advice for companies in terms of using their network? And then Tom, I might just ask you from an Enterprise Ireland perspective and supporting companies at the earlier stage, there were some questions around match funding for Enterprise Ireland HBSU companies and potential options there.
Okay.
Conor.
Yeah, so like we had no network at the start, and I guess my advice would be don't hold back from just reaching out to founders, send them an email and just say what help, asking for the help. We did that for a couple of companies in Dublin, and nobody didn't reply, as far as I remember. Everyone was really happy to just have a 10-minute phone call and give some advice, and it was really useful. And even when the advice the advice wasn't particularly useful at the time, later on, when you're at a different stage, it can suddenly become useful. So I would not hold back from just reaching out to people and asking for help. Dublin seems to be full of very friendly founders who are willing to help. That was my experience.
Okay. In terms of where people will go in terms of getting early stage seed funding or pre-seed funding, I suppose Enterprise Ireland has developed a number of supports in this space. So we have the New Frontiers program, which is a partnership with universities in terms of which we pay a stipend to help companies actually prepare business plans and actually begin, threshing out what they need to do in order to entice investors. We have our pre-seed start fund, which is 100k CLN to go in, and it's matched by 5k for each tranche of 50k. So in other words, you as the promoter puts in 10k. Then we're doing stuff around HPSU, but we also have HPSU investments. So that's an equity investment. Typically that's 250. Under state aid, we can go up to, depending on where you're based, 800 or 1.2 million. So that we can do subsequent rounds. Very much it depends on, because we are a development agency, very much it depends on the number of jobs that are being created, the number of international sales that are going to be created and exports. So the growth of the company, that's really how we look for our return. And so we're not limited to just 250. So it'll depend on the other rounds. But if somebody wanted advice about where to go and what to do, the first protocol is I would always encourage people to look at the Enterprise Ireland website and to do that. And look, I could talk for the next hour about the various different supports that are there. So if you need advice, I would encourage you to engage DI. They've got people can help you with their term sheets or to understand what the mean. Look at our website and these previous webinars. So we did the Equity Matters webinar series last year as well, which goes through quite detailed term sheet analysis and what you should be looking for. I don't know, Conor, how did you leverage any of the EI supports in terms of all that advice when you were starting out?
We did. So, I mean, we had HPSU match funding, which was massive for us at the time. And then we found after that, Enterprise Ireland were super useful in helping us understanding what different, I suppose, methods of not I want to say tax breaks. I don't think there were tax breaks, but other funding that we can get for hiring in Ireland for other countries, and the incentives that were there, just helping us understand what was available.
Okay, very good. What I might do, guys, because we're kind of well and truly over on time, but this has just been a fascinating topic of conversation. I might offer you up with a final thought or a final piece of advice that you could give, a company that is seeking funding or raising. So, Matt, I'll go to you first.
Sure. I think my advice is start thinking about it as early as possible. If you know that you're going to need funding 12 months out or 18 months out, because the cash flow is getting a bit tight, the earlier you can start thinking about it, the better. And get to understand the different types of solutions that are out there that are relevant to your business at that time. And definitely keep speaking to investors, get to understand who they are, what they can offer. They're all coming up with different complex products in this market at the moment, which can be really beneficial. So don't avoid speaking to them, and just give yourself as much time as possible before you take on new funding.
Yeah, and Conor?
When you talk to investors, they will talk about doing a lot of due diligence on your company. My advice would be to do the reverse. We've never taken on investment without contacting previous companies that the investor has invested in. I think it's particularly important for early stage companies, because if you're taking funding from a lesser known investor or non-institutional investor. If investors don't have a reputation to protect, it's more easy for them to push their own advantages whenever they can. So I think it is really important to do your due diligence, just chat to people who know your potential investors, and make sure that everything they're saying is that you can take it at face value, or that is correct.
Okay. Well, gents, I would like to thank you both for participating in this. I found it really fascinating, and probably why I've allowed it to run over time. So much appreciated, and thank you very much. I might just wrap up now, just in terms of this is the last of our sessions. I just would like to point out that one of the things that I always try to encourage companies to do if they're out looking for funding is to change their perspective and to put themselves in the role of an investor. Specifically, an investor is investing in your business to make more money. So obviously there's a risk reward thing. The riskier it is, the more of a reward they want. So you should make every effort to articulate why your business has a fantastic opportunity in front of it and how you are the best team to be able to deliver it, and engaging with investors and telling them these are our milestones, these are the targets, this is what we're hitting, and consistently engaging them to show that you can hit those points will instill greater confidence in your business. So I'll leave you with just that thought. Now, in terms of this is the last session, so I'm just going to recap very briefly in terms of the various different sessions that we did. So we had Professor Jonathan Levy and Nick Keegan from Mail Metrics, and they discussed the growth pathways for scale-up companies. And this session really focused on the building blocks that you need to have in place for your business. So this is looking at all the different aspects of your business, not just if I'm a technologist, I'm focusing in on the technology aspects, but it was like looking at the route to market, or the new term I've learned today, the moat. Paul O'D from Select Strategies and Mark Barrett, the CEO of APC, focused on the importance of taking the time to plan, to remove yourself from the day-to-day activities. And Mark really and this point was strongly echoed with Karen Hernandez from EI and from Owen Leonard from i3PT, which is now called Catalyst. And he really covered off about people, culture, retention, and how essential it was there to scale up your business. It's really important to surround yourself with people who you can trust. So as Conor did, he built out his team, and he got Matt involved as well. So, and then of course, last month's session was Helen Ryan, who is an EI board member and a former CEO of Creganna Medical, and Patrick Dern, the CEO of Crew Medical. And they talked through the board and how it can be really advantageous to helping your company grow. I know a lot of companies tend to see it as a barrier to them growing, but they both pointed out about how an effective board at the various different stages can accelerate your growth. So that brings an end to the series, and if you missed any of them, they're on our website and you can access them anytime you want. I would like to thank everybody involved in the running of the webinars. There's a really strong team here, people in the EI that make sure everything runs smoothly, and of course, a huge thank you to our speakers. So thank you everyone for involvement. Apologies, guys. I've seen the internet went down there, so I'm not sure where I left off, but really what I'd like to say is thank you to everybody for participating in this. Thank you to the team for helping us make sure that everything runs smoothly behind the scenes. And if you want to access our previous webinars, then please go to our website. So thank you again.